Right friends, welcome back to IBPS PO interview series. We are producing 5 modules and these are basically pertaining to how to face banking questions. And as usual in this module we are going to discuss 10 questions. What are the problems faced by business correspondents? Who are business correspondents? Business correspondents are nominated by banks. They can nominate a certain category of people. Around 10 years ago, Reserve Bank of India issued guidelines so as to penetrate the banking services to the interiors of the country, especially small villages and rural areas. With that purpose, the concept of business correspondents was brought by Reserve Bank of India, and these business correspondents who can become business correspondents was also specifically mentioned by Reserve Bank of India, like kirana shop owners, retired employees like that. And business correspondents are appointed by banks to expand their services in rural areas. And what are the problems faced? Business correspondents basically work with handheld devices popularly known as micro ATMs. Each customer will be linked with Aadhaar, and at the same time these micro ATMs are connected to CBS platform of bank. These micro ATMs are connected to CBS platform of bank, and by sitting in rural areas they can perform all the banking operations with these micro ATMs, like depositing money, withdrawing money. All these things can be done in rural areas. But the pertinent question is, what are the problems faced by business correspondents? First and the foremost problem is poor connectivity. The broadband penetration in rural areas is not up to the mark because several banks nowadays enabled micro ATMs for eKYC. You may ask, what is the meaning of eKYC? That is ensuring know your customer norms in electronic way through the handheld device. That database will be cross-checked with the platform of Aadhaar, and for that sufficient bandwidth is required. Not only that, for connecting this micro ATM with the CBS, sufficient bandwidth is required. So in rural areas, bandwidth is the biggest problem. Second important aspect faced by business correspondents is the credibility problem. Because before appointing business correspondents, banks have to see whether this person is credible or not. That mechanism may be lagging in some rural areas. So because of all these things, business correspondents model has not made much headway as expected. Right? You can answer in this fashion. Why pre-2005 notes are being taken out of circulation? Reserve Bank of India extended the date up to probably June 2016. This is probably 4th time they have extended. And the pertinent question is, why Reserve Bank of India want to take out pre-2005 notes? There are 2 reasons for it. The first and the foremost reason is, Reserve Bank of India came up with a new series notes, Mahatma Gandhi series from 2005. That means Mahatma Gandhi series of 2005 for rupees 10, 20, 50, 100, 500 and 1000. These notes are printed as per Mahatma Gandhi 2005 series, and the biggest advantage of these 2005 Mahatma Gandhi series notes are the security features are very high, so that counterfeit currency notes can be avoided. The biggest advantage of 2005 series Mahatma Gandhi notes is basically due to higher security features. Second important point is, it is the world practice not to allow so many series of notes in circulation. Because of that, Reserve Bank of India wants to take out the pre-2005 notes from circulation. And how to identify pre-2005 notes with the post-2005 notes is, pre-2005 notes do not have the year of printing of currency note, whereas 2005 and after, on the back side of the notes, the year of printing of the currency note is printed on the note. That you can bifurcate. But if someone asks why pre-2005 notes are being taken out of circulation, these two are the primary reasons. What do you understand by prepaid payment instruments and micro ATMs? Prepaid payment instruments, all of you are well aware about Airtel Money, M-Pesa. So many of you are familiar with the mobile wallets, smart cards where money can be stored, and you can use this money for some particular operation, and these are prepaid payment instruments. And for issuing prepaid payment instruments, not only banks, non-banks are also allowed. And prepaid payment instruments are regulated by Reserve Bank of India as per Payment and Settlements Act of 2007. Right? So, prepaid payment instruments, or you can say money value instruments, can be issued by banks and non-banking companies, and at the same time they can be utilized for making various payments. And what about micro ATMs? Micro ATMs are handheld devices primarily meant for rural areas, and business correspondents are given these micro ATMs. The main purpose of micro ATMs is they are biometric enabled, and in rural areas, the authentication of the customer is done with the biometric authentication. So, the micro ATMs basic feature is the biometric authentication, and they are handheld devices just like POS terminals, basically intended for rural areas, basically to be carried by business correspondents. What do you understand by Startup India, Stand Up India? The Prime Minister's aim is we should be job creators, not job seekers. The main purpose of Startup India, Stand Up India is to inculcate ecosystem in the country so as to develop entrepreneurs. The entrepreneurs are to be developed with government support, and government wants to support the people with financial assistance, not only financial assistance, by developing incubation centers in IITs and IIMs. You may ask, what is incubation center? Incubation center is the center where your idea will be converted into business venture. By giving all types of support, the idea will be converted into profitable business venture by incubation centers. The main purpose of Startup India, Stand Up India is to support entrepreneurs, to develop entrepreneurs, to make Indians job creators instead of job seekers. And the Prime Minister's aim is each bank branch should support at least one SC or ST entrepreneur and at least one woman entrepreneur. There are more than 1.25 lakh branches of banks in the country, and with this more than 2.5 lakh entrepreneurs of SC, ST, women categories can be developed by banks. That is the main motto of this Startup India, Stand Up India. And please remember, all the details are not available as on the date of recording this, as this program is going to be launched on 16th of January by the Prime Minister. Why China devalued currency? Devaluation of currency. I would like to explain what is the difference between depreciation and appreciation. Depreciation, appreciation of currencies take place because of market forces. When there is a lot of demand for the currency will depreciate. And when there are a lot of capital flows into the country, there is not much demand for the currency. When there are excessive flows and when demand is not there, naturally the currency will appreciate. So this is due to market forces. But devaluation of currency is deliberately done by the country so as to give impetus to exports. You may ask how the exports will improve if the country devalues the currency. And at the same time, please don't forget, states' intervention in fixing the currency value is known as fixed rate mechanism. States' intervention in fixing the currency value is known as fixed rate mechanism. When the country reduces the currency value in comparison to foreign currencies, that is devaluation. When the country increases the value of currency with reference to foreign currencies, that is the revaluation. So, please don't forget, depreciation, appreciation are the mechanisms which will take place because of market forces, and devaluation, revaluation are determined by the country, determined by the government of the country. So, here why China devalued currency means so as to give impetus to exports. I would like to take a small example. If I sell this in America, let us assume if I sell this in America, I will get $1. If I sell this in America, I will get $1. That means I will get 67 rupees with the present day rate. If our government devalues currency to 80 rupees, if our government devalues currency to 80 rupees, what will happen? I will get 80 rupees by selling this. That means devaluation of currency is to make exports profitable and competitive. With that in view, China has done it. Why China has done it? Because of several reasons. China is growing slowly in recent times. After almost 30 years of 10% growth, now China is growing at around 6.8 or 6.7%. Second important point is, it created a lot of excess capacity in the country for manufacturing. For manufacturing, it has created a lot of excess capacity. If the excess capacity is not utilized, then several jobs will be lost. That's why by hook or crook, they want to sell the products. That's why it devalued its currency. Right? Look into the next one. Differentiate between monetary policy and fiscal policy. Monetary policy is the policy determined normally by the central banks. Basic aim of monetary policy is to preserve the intrinsic value of rupee. The value of rupee should not fall. How the value of rupee will fall? My currency's value will fall if inflation is there. If inflation is increasing, then the currency will lose its value. So, the main purpose of Reserve Bank of India in our country is to preserve the intrinsic value of rupee. That means to reduce inflation. If high inflation is there, the currency will lose its value. And what is fiscal policy? Fiscal policy is normally undertaken by the Ministry of Finance. Ministry of Finance will undertake fiscal policy. That means maintaining the difference between expenditure and revenue. Governments, expenditure and revenue, these two are the terms. If expenditure is more, then it is fiscal deficit. If revenue is more than expenditure, it is fiscal surplus. For a country like India, we always have fiscal deficit, and RBI has got no role in fiscal policy. So, fiscal policy is totally administered by the Ministry of Finance, whereas monetary policy is administered by the Reserve Bank of India. What do you understand by financial inclusion and financial deepening? Financial inclusion, making available all the financial products to disadvantageous sections of society. Scheduled caste people, scheduled tribe people, women, people belonging to disadvantaged sections of society, people living in slums. If all the financial products are made available to them, that is financial inclusion. They should have access to organized financial system, like opening of bank accounts, like getting insurance policies, like getting pension policy. If these things are available to all the disadvantaged sections of society, that is a financial inclusion. But a much deeper meaning is financial deepening. Financial deepening means you and I have got access and choice of several products. If I want to take insurance policy, I will have choice of taking with LIC or Bharti AXA. Like that, I have so many choices. Similar choices should be available to the disadvantaged sections of society. That is a financial deepening. So, financial inclusion and financial deepening, these two are the terms pertaining to disadvantaged sections of society. Making available all the financial services across all the sections of society is financial inclusion, and making available different choices to the people so as to make a right choice for investment is financial deepening. And different books interpret in slightly different way, but I think this may be the appropriate answer for this. What do you know about the Bankruptcy Code? Recently, this bill was introduced in Parliament. T.K. Viswanathan committee is associated with this, and if you ask me what is the Bankruptcy Code, I would like to tell you in 2 sentences. One is, business failures are common. Failures in business are also common, and when business fails, nowadays it is taking a lot of time for the stakeholders to come out of it. I invested in some company, that company failed. Then for getting back whatever money available with it by me is becoming difficult nowadays. And so as to keep this thing in mind, business failures are common, and so as to solve the situation arising out of business failure within 180 days, this bankruptcy code is planned in this country. This country has got no bankruptcy code till date. Several agencies are dealing with business failure cases, and once this bill is passed in Parliament, in future all the cases of business failures will be dealt with as per this bankruptcy code, and these are to be dealt with within a span of 180 days. Please don't forget. What do you understand by disinvestment? Disinvestment is by keeping 51% government share. Nowadays, we have several public sector entities. You may ask, what is public sector entity? Public sector entity is majority share held by government. When you take BHEL, when you take NTPC, when you take State Bank of India, majority share is held by government. And by keeping minimum 51% government share, selling balance share or selling maybe 10%, 5% of the shares to outsiders is disinvestment. But government has to keep majority shareholding of 51%. That is a must. So that is disinvestment. And what are the advantages of disinvestment? The advantages of disinvestment are, first and the foremost thing is, there will be accountability. If the government is holding entire 90 or 95% of the stake, then lot of irresponsibility in the managing of the operations will come into picture. So by keeping 51%, if government sells a balance stake, then the public sector enterprise has to function with responsibility, accountability, with the profit as the motto, because these private persons will question the public sector enterprise if it is not run on profitable lines. Second important point is, government will get back its revenue. Government has invested a lot of money in public sector enterprises, and government will get back some money by selling a minority stake in public sector enterprises. So these two are the basic advantages of disinvestment. How do the banks become economically viable? Banks will become economically viable because of the reason, for deposits they pay lesser interest, and on loans they charge higher interest. If you are depositing your money in savings account, they will pay hardly 4% interest. If you are maintaining fixed deposit with a bank, they may pay around 8%. But if you want to take a loan, they will charge you 10%, 11%, 13% or still more. So the gap between this deposit interest rate and the loan interest rate basically makes the bank viable. And if you want technical terminology of what is meant by cost of funds, what is meant by yield, what is net interest margin, please listen to the first lecture of banking awareness, right? So with this, let us conclude this. Please do join for 4th module. Have a nice day. Thank you.